and welcome. I am Piers, CEO of RDX Works, a core developer of the decentralized finance protocol Radix, a public ledger entirely focused on bringing DeFi into the mainstream. This is our podcast, the DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I'm joined by Patrick Hansen, Head of Strategy for Unstoppable Finance, the wallet to bring DeFi into the world. However, Patrick has also previously been very deeply involved in policy in crypto around things like EU policy on crypto, and been a very strong public advocate around stopping the direction, or at least giving people strong advisement on the direction that Europe is currently going on, and what he calls a third way for the EU. So Patrick, thank you so much for coming on the show.
Thanks, Piers. Happy to be here.
So let's start with this idea of, where did this concept of the third way for the EU come from, and where are you seeing like the problems emerging for Europe?
So the idea of the third way is actually that Europe itself, so the EU institutions themselves, are basically building all their digital policies on. And basically what the third way represents is a different way of handling, normally it's personal data, so user data in digital policy. And if we look at, the US side of things, it's normally big, huge corporations that gather those huge amounts of personal data, and they use that kind of data to build profitable private businesses on top of it. If you look east, there is, the Chinese model of basically an authoritarian public government that is gathering all that private data, the personal information of its citizens, and it's trying to build its own digital policy on top of that. And what Europe is striving for is, I think, a third way of managing those kind of digital data flows. That's the more general picture. It tries to basically give its own citizens, its own users, sovereignty over its own data, compared to the power by government on one side or the power by private corporations on the other side. So this is the general third way that the EU is striving for in digital policy. And I think that concept is also applicable to crypto and tech. I think there are a lot of values that align between the Web3 values and those EU values of the digital third way. And that's why I thought it would make sense to write that article that I wrote for Stanford a couple of months ago, why Europe should fully embrace with open arms crypto and Web3, because it fully aligns with its own values. And happy to dive deeper into the different topics there.
Let's take that as a statement, as an opening statement, right? Which is like privacy policy and crypto policy that Europe is pushing forward. So if we look at something like GDPR regulations or general public data, what is it? GDPR, General Data Protection Regulation.
Exactly.
So snappily named. This regulation, for those who don't know, basically gives users ownership over their data, regardless of where it is. If a company has it, it's my data, and I have the right to ask the company what data they hold on me, and the right to ask the company to delete that data if I no longer want them to hold that data, and they have to do that. And if they don't do that, there's some pretty hefty fines. And that regulation came in relatively recently, but you can already see the behavior in companies and how that's actually changing the view of data. Now companies much more see data as like almost this toxic waste that is a huge liability for them if they don't act very carefully around every piece of user data. So it clearly is creating change, right? Clearly creating change in the behavior of these companies. So how does crypto relate to that principle? Or how does crypto relate to the wider principle of user sovereignty?
So I think compared to Web 2, for example, so big, social tech platforms like Twitter and Facebook, where users just drop their content, and basically all the personal data of the users, like European users, US users, live inside of those huge tech platforms like Facebook and Twitter. So my tweets live inside of Twitter. The likes I get, the retweets that I get, they live inside of Twitter. And I have no option, I have no opportunity to extract that data to other platforms, for example. I have basically no right to exit. And that's one of the key principles of the GDPR. And I think the way that Web3 aligns with privacy and that kind of digital sovereignty over your own data is that in a Web3 era, if I build, for example, if I sell my NFT on OpenSea, or if I buy an NFT on OpenSea and I display it on that platform, I am still using that third-party provider to trade that NFT. But at any point in time, if I'm not happy with, for example, the transaction fees that OpenSea extracts, so the value that it gets out of my own content and my own value that I bring to the platform, at any point in time, since the NFT lives on that public, permissionless, neutral blockchain infrastructure, I can just exit. I can just take my NFT and take it to a different NFT marketplace. There are dozens out there. So I think the way that basically Web3 is defined by, for example, by the A16Z investor Chris Dixon, as the internet that is owned by its users and creators and which is governed by tokens. I think if more and more digital data is represented through that tokens, and those tokens live on public neutral blockchain infrastructure, I think that will really allow future citizens, future users to really benefit from that more theoretical construct of digital sovereignty, to do with that kind of data and tokens whatever they want, compared to the lock-in effect that they currently experience within those huge tech platforms, for example.
It's a really interesting concept because I think there's a separation between you can at least create a separation between ownership of objects and the data, the metadata around that, right? So like to use a public ledger right now, I can own an NFT platform and I have the right of access from the NFT platform, but I don't have the right of access to my data on that platform from the point of view of if I want to delete my trading history, if I want to delete the information that has happened as a result of those interactions, that is just on the Ethereum ledger or on the Radix ledger or on the Solana ledger, whatever ledger it happens to be. And as a result, there's actually quite a lot of like personal private information that exists in there. Like, how do you see the interaction between GDPR regulation and public on-ledger, on-chain information that essentially can't be deleted?
Yeah, that's a critical aspect you're raising, and that's especially relevant if we look at, for example, current proposals around anti-money laundering regulation at the European Union, which basically tries to gather those personal data, your name and your home address, and link it to your public blockchain address. And obviously, the risk that it creates is that once that data gets leaked or hacked, and we create those massive honeypots, for hackers, criminals will be able to link your personal identity, your home address, with basically your entire transparent transaction history on chain, the amount of assets you own, the different counterparties, DeFi protocols, for example, you're interacted with. And that creates massive risks, both in the digital world, through like phishing attacks and hacks, but also in the physical world, as we have seen already a bunch of times after, the personal data from Ledger was hacked, for example. And that was not even blockchain data. That was just, data from users that bought, for example, a Ledger Nano. So I think the aspect you're raising is critical. I think that is something that we as an industry are also trying to raise more awareness for within political stakeholders, because I don't think they get to the fullest extent yet how much more sensitive that kind of data is compared to your traditional financial data, like an IBAN number, for example, in the European Union.
Right.
Yeah.
It's like giving someone access to your full banking history, right, rather than just an IBAN number.
Exactly.
And I think that there's some really interesting points here that I'm sort of only starting to, like, as a result, having worked more with regulators over the last sort of year or 2 years, and like the anti-money laundering regulations and the VASP rules and the travel rules and all that kind of stuff. There's this thing that has been really interesting, is that regulators have kind of crypto sold regulators on this idea that chain analytics is a good thing, right? So they've gone, hey guys, here's this really great tool that you have that makes sure that you don't have any like illicit funds going through an exchange. It's called chain analytics. And the regulators have gone, oh, that's great. But then on the other side, it's more than is asked for in the banking system. Like in the banking system, what you have to do is you pass across the information when a transaction occurs between two banks. The banks have an exchange protocol, which is like basically just a narrow form of the travel rule, where the bank A is sending money to bank B, and bank B asks bank A, hey, give me the information about this person? And it's normally, full name, date of birth, and country of residence. And that's enough to be able to do PEPs and sanctions. So to be able to work out if this person is politically exposed, to work out whether or not this person is a terrorist, all that kind of stuff. And that's sufficient, right? And then if I, as an individual, come to a bank and I got $1 million in cash in a briefcase and I deposit at the bank will say, where is that money from? And what is your general source of wealth? But as long as I can come and I can prove those two things, I can say this is from a legitimate source and my wealth is legitimate. The bank doesn't then go, I need all of your transaction history to date that you've ever done. They're just like, no, that's sufficient. So that's the baseline, right? And now what we're doing is we're requiring this extra stuff. But even more worse than that, in my opinion, is that privacy coins are currently being actively worked against by regulators and by exchanges. So Zcash is very difficult to buy on exchanges, and Monero is very difficult to buy on exchanges, and it's getting on less and less exchanges. And so what do you think of, how do you think privacy and privacy coins and regulation around that, do you think there's a space for that in the EU as well?
So what worries me most is basically if the two concepts of anti-money laundering, so the traditional one of just gathering personal data, and then also the blockchain native one of blockchain analytics and transaction monitoring, if they are added on top of each other, because
Right.
that is what creates most of the risk, in my opinion. I'm a big proponent of sensible anti-money laundering rules. All over the world, but especially in Europe. I think with regards to privacy coins, it makes sense for privacy coins, since there is no way to track if those funds are coming from, I don't know, criminal activities, the financing of terrorism and those kind of things. It makes sense, from my personal opinion, in those kind of instances, to use more traditional means of checking for that kind of money laundering risk or terrorism financing risk. But when it comes to different kind of blockchain protocols and crypto assets, like, for example, Bitcoin or Ethereum or all of the main ones, I think that the better approach, and that's the approach that the industry is already currently using, and that, in my opinion, and that's also the data is also showing that, for example, if you look at the recent crime numbers from Chainalysis, for example, they show that only like under 1% of crypto transactions are linked to criminal history and criminal activities. That's basically nothing compared to the traditional sector. And I think when it comes to those kind of blockchain protocols and crypto assets, it's not helpful from an AML perspective to just put the same traditional AML rules on top of the better suited blockchain native AML alternatives that we have out there. And that's something that we are trying to advocate for at the European Union, for example, where the current transfer of funds regulation, the TFR, is being discussed. And is in its final stages of negotiations in the so-called trilogues within the European Commission, the Council, and the Parliament. That's really something that we're trying to push out of the regulation, because we think, on the one hand side, as we discussed, it creates huge like privacy risks and personal data risks. On this, like, the second argument that I usually use is that it's not helpful from an AML perspective to try to identify any kind of self-custody wallet that interacts with a centralized custodian or exchange, in my opinion, because it creates, those two separate worlds of that regulated entity, centralized company world and the peer-to-peer self-custody world. And I think it's not in the interest of regulators and AML authorities to completely separate those two worlds and have no impact any longer on that peer-to-peer market. And then the third argument I use in those kind of discussions is that setting up unilaterally as European Union the strictest AML rules globally is just not helpful from a economic competitiveness standpoint. So if EU users have to identify their self-custody wallets with European exchanges, for example, and they have to just go through very lengthy and costly and burdensome identification processes and compliance requirements, I think they will just have too many incentives to just move on and move towards other like foreign exchanges, for example. And that obviously thwarts the original goal of regulation, which is consumer protection and anti-money laundering. So, and that's also, happy to dive deeper into that part also of the discussion, which is, where does the EU stand right now in terms of economic competitiveness? If you look at Web 1, Web 2, Web 3, that's obviously a huge problem right now if you look at the current status quo of the European economy.
So we've talked a lot about like sort of what we want and what we don't want, but like what is, can you be concrete? Can you more concretely describe what you think should be the European regulation around anti-money laundering when it comes to crypto?
Sure. So I think we have to distinguish the different kind of transactions. I think for transactions between two different regulated service providers, so an exchange on one side and another exchange on the other side, I think there's no way around, gathering that private information of the customers and, having that information sent from one player to the other. I think that makes sense, and I think although it is quite costly to implement.
Let's argue that. Why? Why does it make sense that two financial institutions have to exchange information? Like what harm are we trying to prevent here, and where is the data that backs up that this actually prevents that harm?
I think the difference with self-custody wallets is that those centralized service providers, they usually have pooled wallets, so they don't, they oftentimes you can't really tell like what kind of public address is, linked to what kind of individual or customer. So that's why I think compared to, self-custody wallets, it could make sense to have this kind of private data or personal information on top for anti-money laundering reasons. Obviously, we can also discuss, more generally speaking, the benefits of those kind of AML rules and how effective those really are. But just from a pragmatic and practical standpoint, I would say let's focus, the lobby efforts and the political work on those issues that matter most to me and to, I think, the crypto space, which is the future of self-custody wallets, in my opinion.
So you're saying, if I understand correctly, that the reason that exchanges should exchange information about their customer base between each other is because they essentially act like mixers. So they're one big pool of assets, and when the assets come in, they then put them into a single or a subset of keys that then essentially adds privacy to who that asset owner is. And when a user pulls that asset off the exchange, you're essentially pulling it out of a set of mixed funds. So that's the problem that you're highlighting here.
That's one reason, yes. So I think that's yeah, that's the AML reason, and then there's the more practical reason of, if we look at financial intermediaries and financial services companies,
Right.
I think there is no way of having anti-money laundering rules applied to them. It's the same thing for banks and financial institutions in the traditional sector, that they have to gather that kind of information. And so, just from a pragmatic standpoint, I think we won't achieve anything if we try to fight against any kind of rules. I think we should really focus our efforts and our resources on those self-custody matters.
Right.
And that's where I think those kind of more blockchain based analytics and on-chain transaction history tools like Chainalysis, CoinFirm, Elliptic, and others, that's, I think, where that makes the most sense. If, for example, on one side, a centralized exchange, Coinbase, Binance, and others, they want to interact with a self-custody wallet on the other side, Ledger, MetaMask, whatever. I think here in that kind of case, it doesn't make sense that the centralized service provider is obliged to gather, the private information of the self-custody wallet on the other hand side. It's not a financial company.
The owner of the self-custody wallet.
Exactly,
Right?
because that's how it's currently, required in the TFR EU regulation, which originates from the FATF travel rule.
Right.
So here, in that case, in my opinion, the industry should just move forward and try to, improve with those methods of on-chain analytics. If that kind of public address from the self-custody wallet is flagged for anti-money laundering or terrorism financing, obviously those kind of centralized service provider, they should be prevented from interacting with it. But if otherwise, there's basically no risk attached, no risk flagged from those on-chain analytics, I think there shouldn't be a need for gathering, storing, and also verifying that personal data, because I think that would basically make the lives of service providers really difficult, and that would cut those two worlds of centralized service providers and self-custody wallets into two different worlds, and I don't think that makes sense from an anti-money laundering perspective.
So, because we have the on-chain analytics rules, and because the self-custody essentially identifies like individual users, generally speaking, your argument is essentially it's unnecessary to add this extra layer of requiring the centralized services to gather that information. Because you can use on-chain analytics to watch where those funds go, and then if they come back, then you have a way of doing it that doesn't require gathering more information from the individual.
Exactly.
And that would basically be in line with a number of other jurisdictions, right?
Yes, that would be in line also with, I would say, also the FATF travel rule.
Mm-hmm.
So the TFR regulation, how it is currently being discussed in the European Union, is basically the maximalist approach of anti-money laundering. It's basically we have to gather, store, and verify all kind of personal data, be it centralized exchanges, be it self-custody wallets. That's the maximalist approach. And I think the more reasonable and the more pragmatic approach is to say, okay, let's gather that kind of data between centralized service providers. Like, obviously, from an ideological standpoint, I'm not a huge fan of that either. But we have to live in a world of financial regulation, and we have to work with regulators. And I think there's no way around that. But on the other hand side, for transactions with self-custody wallets, it doesn't make sense. It creates a lot of risk. It's not effective, and it also just cripples the competitiveness of those EU players if you impose those kind of rules, because they're obviously, we haven't talked about that, but it's super difficult from an operational perspective, or even impossible for a centralized exchange like Coinbase to verify the identity of a self-custody wallet, which is not linked to a customer of Coinbase. It's almost impossible. So the only outcome would be that Coinbase would have to cut that kind of transaction. And I don't think we want that to happen.
Right. What reason is convincing to the European Union, and why do you think the European Union is anti-crypto?
I think the most convincing argument when talking about anti-money laundering, especially, is just the effectiveness of those rules. So we have to show that to European regulators, and in the best of worlds, we have to back that up with data and stats. We have to show that those kind of more crypto native analytics and AML tools are more effective than the traditional ones. And I think that are arguments that are that are embraced by regulators. I think other arguments that are like more focused on the ideological standpoint or on privacy, they matter obviously, but I think their success rate will be smaller. And with regards to the other aspect, to the other point, I don't think that the EU is necessarily against crypto. I just think that when it comes to regulation, the EU often has, a kind of all-in approach that it wants to become, the global leader in regulatory matters, and that it basically wants to set the global standards on all kind of digital regulation issues. And that's why, unfortunately, sometimes we are confronted with those kind of proposals. But luckily, once those proposals are out and the industry engages, in advocacy, in negotiating, in discussing those issues with EU regulators, there are a lot of open ears. There are a lot of members of parliament, for example, that are open to those kind of arguments. But more generally speaking, I don't think that crypto has reached, in the EU and in Europe especially, that kind of mainstream adoption and mainstream attention that it has reached in the US, for example. We don't have, mainstream cultural celebrities yet talking in the EU about crypto. We don't have the largest crypto businesses in Europe that, employ thousands and thousands of people compared to, for example, Coinbase in the US that is publicly listed, that has thousands of employees, that create a lot of jobs. So we don't have those huge crypto businesses in Europe. And that makes it a little bit harder to basically try to convey the importance of crypto from an economical and financial standpoint to the EU. And that's why also I've been trying to outline those different reasons in different articles. And one important one from my perspective is the economic and the financial argument. So from an economic and financial standpoint, why should the EU go all in crypto? And happy to dive deeper into those aspects.
Show me that.
Okay, let's start with the economic argument. Obviously, the current status quo of the European economic landscape is not looking super good. Our share in basically global equity has halved over the last 20 years. We don't have a single tech giant. I don't think even one of the top 20 tech giants, I don't think a single one is European. We are lagging far behind in terms of venture capital investments, in terms of tech unicorns. So from an economic standpoint, it's not looking super good. We're clearly losing the Web 2 era, so the tech era, and I think we have to make sure that once Web 3 starts, and once the new businesses are created for the next era of the internet, that the picture will look better than it currently looks. So from an economic standpoint, I think there's a huge need for innovation and disruption in the European economy. And then the second argument, the financial argument, obviously we're entirely dependent on the US in terms of capital markets and in terms of international payments. If we look at, for example, what happened also from a geopolitical perspective after the Iran sanctions, for example, from the former president Donald Trump, the EU was heavily against that kind of sanctions from a financial perspective, but it just had no way of just circumventing that. So it tried to do that. It tried to build a known financial messaging network called Instex, but it barely had any traction or adoption. So obviously, the US dollar has the global reserve currency. Almost like half of all the global trades are denominated in the US dollar. The EU is completely dependent on the US dollar when it comes to trade, capital markets, and payments. And I think there's a big incentive for the European Union to support, a more neutral public financial infrastructure, which is currently being built, with those public blockchain networks. And obviously, the EU has way less to lose from the disruption that those crypto networks herald. So the EU doesn't have Wall Street. The EU doesn't have Silicon Valley. The EU doesn't have the global reserve currency. The EU actually has a currency that kind of stands on shaky legs, right? We have a common monetary policy, but we have national fiscal policies. So we have national deficits, national debts, national budgets, but a common monetary policy. That's a very fragile, foundation for the future. So I think just overall, the EU has a lot to win from economically speaking and financially speaking from going all in on crypto, and it doesn't have that much to lose from the disruption. So that's the short pitch.
So how's it? But like that's great. So, but does in the last 20 years the reduction in capital, the reduction in the equity share of European companies, is that because Europe has made itself uncompetitive from a regulatory point of view?
I think there's so many different reasons that play a role here. Definitely the regulatory one has a share. How big is that share? I don't know. There are massive other factors. There's a lacking investment in R&D in Europe, which is one of the major reasons. There is a lacking funding ecosystem. So there's just a lack of venture capital in the European Union. There's obviously a mentality and a more cultural reason that plays a role. So I think in Europe, in the EU, we don't have the same kind of entrepreneurial idols and role models that the US has, for example. So it's many different reasons that come together and that contributed. That it's also the missing unified EU market. We still have kind of a patchwork of national regulations. So if small like EU companies and startups want to scale, it's much more complex and complicated for EU startups than it is for Chinese or American ones. And there are so many reasons for that, but definitely regulation is one of them.
Yeah, it's an interesting one. It's not a question I actually know the answer to, but it's like, as I'm sitting here and asking myself, like, regulation is one of those things that is going to create barriers, but it's not necessarily the thing that's going to spark the starting of companies. It's the thing that's going to kill companies on the vine. And so the question, and I think it's an important one for the European Union to ask. Like, there have been attempts, as you were talking about, we don't invest enough in R&D. Horizon 2020, the European Union's fund to try and fund R&D, like, they didn't manage to even give out all of the funds that they had earmarked for that. Partly you could say it was because the process was difficult and bureaucratic. But, you could also ask, is it the European Union's role to actually invest in this stuff in the first place? But then, how do you get more venture capital? How do you get more people to take risks in this in Europe? And as you say, cultural norms are really big. I think if Europe, my personal view, just sort of listening to what you're saying, if Europe wants to really make a play for crypto, I think it can't just be parity. I think it has to be more aggressive. If it actually is genuinely serious about making Europe the place that people choose to start their crypto companies, then it needs to go back to what are we trying to prevent, and what is the way in which we can actually prevent that. A simple example would be no AML KYC, but the European Union has some kind of ledger monitoring tool where it can at any point require enforcement at an exchange. So it takes on itself the responsibility. It says any business can come here and can set up an exchange and can set up wallets or whatever. What we will do is we will watch them. And then you just declare to us what wallets you control. You have to do that. And then at any given point, we can come to you and knock on the door and say, we've been watching this transaction group across the entire ledger. We want you to go and find more information about that person. And only at that point are they required to go and gather information. At the point the regulator, the enforcement, is actually saying, we now want more information. Now, obviously, that pushes a load more burden on someone else, and it makes it much easier for businesses to be here. But I feel like it's only in that kind of expansive conversation can you make it easier for smaller companies. Whereas, like, I'm a small company, I can't build a compliance department, I can't build an AML KYC processing stack, so I'm not going to choose to build here because I can't just like push out a business. Instead, if the regulator is going, instead of me making it criminal for you not to do something, we have all of the data. It's all on ledger. We will monitor. And if there's a problem, we'll come to you and ask you to do something on our behalf. Something like that, I think, would be interesting.
Yeah, I see where you're coming from, but I think it's a kind of, utopia for the European Union. It's more the American approach of just, letting innovation grow and letting innovation happen, and then look very closely into where there are shortcomings from a consumer protection standpoint, where there might be like an uprise in criminal activities, and then to step in and really harshly regulate that kind of activities. And it's just not how the European Union works. But I want to add one point, because I think I want to make that clear. I think actually I'm a huge fan of harmonized EU regulation on all kinds of topics. So I think the markets and crypto assets regulation, for example, which is trying to harmonize all kinds of rules and requirements for crypto asset businesses in Europe. I think that's a huge step forward, because what we have right now, if I want to build a German crypto exchange or a German crypto custodian, I can scale that business to maximum 80 million people. And if I want to scale and scale my business towards France and Italy and all the other EU countries, I have to go through all the same kind of financial licensing processes again and again and again. And I think, so I'm generally speaking, I'm a huge fan of harmonizing the EU regulation market, of creating, binding rules, of creating a fully harmonized internal markets of like 400 plus million people. The question is just like how far should that regulation go, right? And that the devil always lays in the detail.
Devil always lays in the detail, indeed. And and a lot of the time, the guidance isn't clear either. They'll be like, this is what we want the rules to be. And then you'll be like, yeah, okay, well, what about this specific example? And they'll be like, I don't know, you work it out. It's like, that's not helpful. That doesn't help me do my business. So my favorite one is the AML 5D. If you actually go back to the regs and you go, okay, so how do I know if someone is, if I've done sufficient identity checks on a person, and that I can therefore believe that person is, is who they say they are. And it says that the checks have to rely on a reliable source, but it doesn't specify what a reliable source is, or whether or not you have reached the threshold of reliability of the source. And it's just like,
Yeah. It's the same thing for the current TFR. So for the current AML rules for crypto, the regulation says, those information, they have to be transferred between the crypto asset service providers, but they don't say how. Currently, there is not a technical, framework or messaging network for those crypto asset service providers to exchange those informations. I totally see your point. It's always the same, and it's the same for the GDPR. It's the same for crypto regulation. The EU moves forward and sets like ideal regulatory standards and goals it wants to achieve. But sometimes, or I would say even oftentimes, it doesn't have the necessary in-depth look at how those technologies work in order to give clear guidelines how those goals should be achieved. So 100% agree with you.
Well, it's been such a pleasure talking with you. Thank you so much for coming on and giving us your thoughts. If people want to find out more about your project, do you want to just give us a quick overview of what Unstoppable Finance is doing, where you guys are, and how they can find out more about it if they want to?
Sure. Yeah. So people can check out our website at unstoppable.fi. As mentioned, we are building basically a DeFi investing app where we're trying to integrate DeFi applications natively into a mobile app that is super easy to use for people, to try and experiment with DeFi protocols, DeFi applications. And we are currently in building mode. We will launch our first product in 2 months, so pretty soon. So I invite everyone to look at our website to obviously register for our waitlist. And apart from that, for those who are interested in those policy matters, I am quite active and vocal on Twitter. You can just reach out and follow me at Paddy _Hansen. And thanks a lot, Piers. It was a great pleasure.
Paddy or Paddie?
It's actually PADDI.
PADDI _ Hansen HANSEN
Exactly.
on Twitter. Cool.
Exactly. Thanks a lot, Piers. It was a great pleasure.
Absolute pleasure. Next time, I'm sure we'll have another conversation when this regulation comes out.
For sure.